Picture a world where currency traders stare at flashing screens in Singapore and London, headlines about shifting capital flows. Central bank maneuvering and political uncertainty ripple through markets in real time, fueling whispers that the architecture of global finance is under quiet pressure. And while such moments naturally spark dramatic speculation about the fate of the US dollar or the rise of new monetary powers, the underlying story unfolding today is less about sudden collapse and more about a slow, strategic recalibration driven by China's efforts to broaden the international role of the yuan, Japan's delicate struggle to stabilize its currency after years of ultra-loose monetary policy, and Washington's determination to protect the dollar's central position in the global system, even as deficits rise and geopolitics complicate trade, because in recent months, Beijing has leaned harder on long-running policies designed to make its currency easier to use abroad by reinforcing Hong Kong as the primary offshore yuan hub, encouraging banks to issue more yuan-denominated loans and bonds, expanding currency swap lines with trading partners, and investing in payment systems that allow cross-border transactions to bypass traditional dollar-centric channels, all while Chinese companies continue to secure overseas energy and mineral assets and global manufacturers, deepen supply chain ties with the mainland. Moves that economists describe as practical steps toward reducing reliance on foreign currencies, rather than a near-term attempt to dethrone the dollar, whose dominance still rests on deep and liquid U.S. financial markets. The scale of Treasury issuance, strong legal protections, and the dollar's entrenched role in commodity pricing and international reserves, even as that dominance is periodically tested by political rhetoric, fiscal debates, and shifting interest rate expectations. And on the other side of Asia, the spotlight has turned to Japan, where a weakening yen, rising import costs, and the prospect of higher inflation after decades of stagnation have placed policymakers under intense pressure to defend currency stability without detonating the country's enormous government bond market. Since Japanese investors are among the largest holders of overseas assets, and any abrupt reversal of those flows could amplify volatility in U.S. and European markets, particularly if carry trade positions built on borrowing cheaply in yen were suddenly unwound. Yet Tokyo faces stark trade-offs because raising rates aggressively could inflate debt servicing costs and threaten financial stability, while doing too little risks further currency depreciation and higher prices for households and businesses that rely heavily on imported fuel and food. A dilemma compounded by the fact that coordination with Washington on currency intervention, once a familiar crisis management tool, is now politically sensitive as U.S. officials emphasize protecting domestic financial conditions and guarding against actions that might undermine confidence in the dollar. And this triangular tension between Beijing's incremental internationalization drive, Tokyo's defensive balancing act, and Washington's focus on sustaining the dollar has become a defining feature of today's monetary landscape, one in which global investors parse every central bank statement for clues about liquidity provision, bond buying programs, or future rate paths, while governments quietly hedge by diversifying trade invoicing, broadening reserve holdings, and securing strategic commodities, creating an environment where gold purchases by central banks, bilateral trade agreements settled in local currencies, and pilot projects involving digital settlement systems attract outsized attention even though they still represent a fraction of overall global finance. And analysts caution that sweeping claims about an imminent end to the dollar era overlook the structural advantages the United States retains, as well as the obstacles China would need to overcome to elevate the yuan further, including capital controls, regulatory transparency, and investor confidence in legal and political institutions. Meaning, the more realistic trajectory is one of gradual diversification rather than abrupt replacement, with multiple currencies playing regional or sector-specific roles alongside the dollar. Yet the stakes remain high because even incremental shifts can reshape borrowing costs, trade patterns, and geopolitical leverage over time. particularly for emerging economies that juggle exposure to dollar-denominated debt while courting Chinese investment, and for exporters who weigh whether invoicing in yuan or yen could shield them from exchange rate swings. And so the narrative taking shape across financial capitals is not of a single dramatic rupture, but of a complex, slow-burn transition in which competing policy priorities, demographic pressures, election cycles, and technological change intersect, forcing central banks to walk ever narrower paths between supporting growth and preserving credibility, and leaving markets acutely sensitive to signals that once seemed routine. Because in this evolving system, confidence itself has become the most valuable currency of all, and maintaining it whether in the dollar, the yen, or the yuan now depends less on grand declarations and more on the steady, often opaque work of managing debt, inflation, and cross-border capital in a world that is steadily becoming more fragmented, multipolar, and cautious about the assumptions that governed global finance for the past half-century.